very warm welcome to everyone. I am Shrija Agrawal, and you are watching the fourth dispatch of our series, Future of Dealmaking Capital Bravado. The theme for today's discussion centers around technology, which really is at the heart of dealmaking now. The sector has been the clear winner throughout the pandemic. Sustained demand for technology products and services enabled strong growth in the sector, which in turn has encouraged higher valuations in M&A. Just to give you a perspective here, the Dow Jones US Technology Index has climbed 48.05% in the last 12 months and is showing gains of more than 20% for the year to date. Technology companies like Amazon have posted record sales. Valuations in the sector have soared as a result, but deal makers appear to be reserving high prices for those technology companies of the highest quality. Taking a look closer home, and I must give you this perspective that deal making has hit $19 billion in the first half of 2021 as investors filed into fast-growing digital economy, and that too only for Southeast Asia. What we are really seeing is that there's a new era of inclusion, collaboration, and innovation that is beginning, and online platforms are taking the charge. Technology is making this so. Look at this. Previously, only those with resources or right connections could get started during tough times. Think about the cheap or even free and abundant online resources now available to entrepreneurs and innovators compared to the financial crisis of 2008-09. A big difference between '08 and now is that it's much easier to start a company because of major technology advancements compared to 10 or 15 years ago. Between 6 to 8 million businesses which are started each year, a majority of them are building their businesses on the cloud. The widespread availability of technology infrastructure like cloud computing has actually lowered barriers and like how for entrepreneurs, regardless of their background or expertise. Technology supporting remote work also make it easier for these founders to acquire talent outside their niche geographic areas. All of this and more is spurring the rise of this phenomenon called the digital economy, which is now at the heart of an unprecedented deal activity. While on one hand, we have capital providers sitting on huge amount of dry powder to put to work, there are also a host of regulatory considerations for investing in technology, especially in the new normal. To talk more on this and break it down, please help me welcome Sanjay Kukreja, Managing Partner and Chief Investment Officer at ChrysCapital. Also joining me are partners from the law firm JSA. Please help me welcome Lalit Kumar and ChrysCapital. Gentlemen, it's my sheer pleasure and privilege to welcome all of you to this full dispatch of this amazing series, Future of Dealmaking. My first question to you, Sanjay, let me begin with you, is that ChrysCapital has really sort of held out on its own. I mean, there's top quartile performance and it's been consistent and steady. And the sector focus also seems to have evolved as the way ChrysCapital as an organization has evolved. We are seeing a lot of investments happen in the technology sector from the firm, but which really is also kind of emblematic of the private investments we are seeing in the private capital space. So what really has changed?
So I think, look, ChrysCapital, we've always had a sector approach, right? And we've been focused on, 3 or 4 sectors which have really, been our large mainstays. So pharma, IT services, business services, technology is a part of that overall scheme of things, financial services. But over time, we've expanded that, and today we cover 8 sectors. So maybe, 10 years ago, we were doing 3, 2.5, 3, 4, but over time, we've actually become much more dominant across 8 sectors. Common themes, export-oriented themes, there are also domestic consumer themes, and obviously technology cuts through everything, as you pointed out in your opening remarks as well. So that's playing out. I think that the question is, how has ChrysCapital evolved in this journey? I think one is we've obviously looked at a much more sort of wider sector network to do, and not just 8 sectors, but subsectors. So you can say you're doing consumer, but what does that mean, right? Are you really focused on consumer tech? Within that, is it foods? Is it, various different aspects to play? And I think we're bringing a sharper and sharper focus on each of these subsectors. And that's really allowing us to actually increase our deal making capabilities and speeds. We've actually come off a very strong run. I would say in the last year, we've deployed north of 500 million. And also in terms of exits, had $1 billion plus of realization. So just in the post-COVID environment. So it's been a very strong active period for us. And we're very excited about the opportunities, the various sectors hold for us in the future as well.
But tell me one thing, Sanjay, that private equity, generally speaking, has really been known as an asset class which relies on predictable and steady stream of return. And when you talk about technology and technology investing per se, one really sees that is it perhaps like the fear of missing out playing out right now? Because it was kind of a space relegated to more venture capitalists who are perhaps known for taking bets which are much riskier, where the path to profitability is perhaps not known. But now I see that a lot of private equity capital is also flowing into these kind of companies. And uh, and I think every company is labeling itself as a technology company anyway. So the tech element is behind every word. The food tech, there's a real estate tech, there's reg tech. Everything is a technology company. It's also in want of higher valuations. One can argue that. So what is attracting or drawing or perhaps seducing the private equity so-called steady, serious, boring money to something which is so sexy and which is much more risky, I would say.
No, it's a good point, Shija. I think the way to think about this is if you just look at what's happening in the sort of new tech space, if you just talk about that and ask yourselves, is there an overwhelming environment of greed or fear prevailing in the market, right? And I think in that barometer, it's very clearly greed is the overwhelming sort of emotion that's playing out, right? Because these companies are doing well, and therefore there's been some easy money that's been made historically, recently, and there's strong momentum, and therefore lots of people are jumping in, right? So to your point of FOMO, etc., saying, look, can we come in and make good decent returns? So I think in general that's played out in various sectors in the past as well. If we agree that that is the predominant sort of emotional behavior out there, you can also agree that in tech especially, it's a winner take all markets in most segments, right? So it is also a period in which big mistakes are likely to be made, because while you fund many different companies, not everybody is going to be successful. So it's a period where I think one has to have heightened sort of a sense of caution before you jump in and really back on the winners, because the fundamental trend that's causing people to jump in is actually a very long term trend, and one that's what's creating the excitement levels going up for everyone, because the macro trend is very powerful. Some of these companies have network effects, they have a large consumer market, and they can certainly grow without the burden of sort of capital and platform and all of those things to play out, right? You could just certainly scale up quite significantly in this sector. And so that scalability is the seduction of making excess return that's playing out. But what that does is also it creates fundings for a lot of different companies, and therefore not everybody's going to be able to make it. So once the dust settles, there will be a lot of people when the party's over who'll be picking up the broken plates, and unfortunately, that's the nature of capitalism at play. But there will be some very large winners. Will there be a $50 billion market cap created in India, or 100 billion even over time, the next 5-10 years in the sector? Yes, right. Question is, are you going to be behind some of those? Are you end up? That's where the choice and the selection criteria becomes very important. And so
So what?
firms like us are approaching this actually very differently.
Yeah.
So the industry is also maturing, because I think you had a lot of the VC money play in earlier, where there was the VC risk, right? Because amongst 10, only one or two are going to be really successful. There's a drop-off rate. Companies are sort of fighting from how much capital they raise in the marketplace as well. I think folks like us only are excited when leadership has emerged, right? And when unit economics are also relatively established. So we're not trying to take the risk of is the company profitable, or is it really going to make money, right? We are coming in at a stage when we know the economics is broadly settled. May not be an aggregate level, but you can break it down to a business and say, okay, market X is done well, and or segment X is done well, and you're expanding it here, etc. So, but it's diligenceable. And you've figured out the unit economics. You also figured out leadership. So it's not as if there are 20 other people trying to fight to create. There may be other people who are actually doing. But let's say 60-70% of the market share is between two or three large players. So at that point, we feel like the competition intensity is at least settled, and therefore we get comfort that, look, it's somewhat similar to the sectors that we may have looked at in the past. Somewhat similar dynamics. Having said that, there are also very major differences. I think these companies can scale faster. Their business plans change much faster. They respond to situations faster, and therefore stability of annual operating plans is different, etc. So we have to be a little bit more agile and nimble to be able to invest in the sector. But I think there's something we bring to the table, which is having navigated much more mature companies which have gone public, and sort of how to manage these companies are run very differently as VC run companies, etc. But once they grow into market leaders and they sort of come into their own, there's a different way that when they're listed companies, their expectations of analysts, the street, how they manage it will have to be different. Cash flows will be looked at very, it's okay to go public, but once your loss widens, how will the street react to that at that point in time next year or a quarter after that? And I think that's a journey we feel we can handle these companies because we've been through it in various aspects, in our 20 years of past.
So what I understand is that definitely there's a big secular trend of digitization, and private equity firms want to partner with that. I mean, there's $50 billion outcome, $100 billion outcome, and there's a huge temptation to be part of it. And you said that the way you look at companies, the lens is different. Perhaps you bring more financial discipline to the table. And you also mentioned that there's a lot of learning also happening on part of the PE firms to invest in these companies as the AOP perhaps, annual operating plan also changes very fast. The agility is much higher. You have to be with speed. So tell me one thing, Sanjay. We are seeing, and you also mentioned this, that a lot of these companies were VC funded. So the playbook was different. But the minute you go public, you have to be very, very ready for higher scrutiny. So are these companies really ready for that? That is an interesting question for me to ask you, given that you have also handheld a mature company IPO process. And in India, we are seeing a lot of private, especially internet companies, trying their luck at the Indian bosses. We saw a successful super listing of Zomato, but we also had a somewhat tepid listing of Cartrade, for instance. And a lot of ambitions are getting higher now with internet entrepreneurs thinking that they can perhaps replicate the success of Zomato. What really is your viewpoint here, from private to public? What really are the considerations? And are these firms really ready for it?
Yeah, so I think the thing here is, I think there's clearly a beeline for, companies in the digital space to actually go public. I think, if you're not profitable or you're not close, you don't have visibility to get there, it's going to be hard because, ultimately listed investors look at things very differently. Now, either they're going to be able to educate the investors to look at themselves in a very different way, and they may be successful at it initially. But, as you kind of yes, the stories have come together. People want to look at those metrics over time, but I think the scrutiny that you come, in when you once you're a listed company, people want to look at the same set of metrics over and over again and over time. And the minute you move to changing goalposts and say, okay, no, now I'm not looking at this, I'm looking at something else, or there's another area that you want to look at because that's where the future is, and it's no longer here where we looked at. I don't think that markets really react kindly to that, those type of situations. So that will play out as these companies go public and figure that out. I think the companies that have stability, there are now, what we are beginning to see is a lot of companies. It's not just a handful of companies that are profitable in India in the new economy space today. There's a bunch of them. And so as leadership has emerged, profitability is also emerging in the sector. And so these companies then do have the wherewithal to actually go public. And they should go public because ultimately they don't really, need that much more capital to subsequently grow further. So it is not one of those situations where you need a round every 6 months and and continuously, which is what they've been used to in the VC world because they needed the money to get to this point. But once you've truly reached to that point, ultimately, you don't need excessive dilution thereafter. And also, it's good for the country, frankly, from that perspective, for retail investors to also partake in this whole digital revolution, if you will. That will happen in India, no doubt, over the course of the next 10, 20 years. Um, so it's more sort of choices and more sort of wealth creation for India in aggregate. I think that's very exciting to see. Um,
Okay. Lalit, I would like to sort of bring you in also here. Just to sort of on Sanjay's point, what he mentioned on the playbook for private companies going public, and he mentioned very categorically that companies who are not making profits will have a tough time. I wonder what really is your viewpoint here, because investors scrutinize listed companies differently.
Sure. Thanks, Shuja, and I tend to agree with Sanjay. But also, if you see, there is a lot of capital already pumped in, and it's burning out. In my view, the cash is burning out, but the hope is there. A lot of loss-making companies are still going for public, and their IPOs have been successful, and we've all seen this in the bull run. So therefore, yes, it's very important that they should not be in losses for a very long time to come. They should sustain their growth, because that is what will get good exit eventually for these investors. And as and when the companies go public. But yes, it does matter. And in fact, when we undertake our diligence, although we do it from a legal standpoint, we also review it, that what's the financial position of the company, whether it's in losses or it's has growth potential. And but the valuations are like hitting the roof, because if you see the valuation of these companies, so I think people are betting much more in the future of this, because there is tremendous growth in my view over time to come, as you and Sanjay also mentioned. So therefore, I think yes, I mean it's time for the tech companies and the technology companies to, for some time, to flourish, being the new age companies.
Okay. Sanjay, I would also like to sort of pull you in here. I mean, to your earlier point, to the fact that the private equity firms definitely need to be part of the digital revolution taking place right now. So capital definitely is super abundant. There's huge amounts of capital right now. And I think some way entrepreneurs are working with this innate realization to operate in a world as if capital were free. What does that mean for private equity firms having to disrupt themselves at a time when the color of the money is ultimately green? You have ChrysCapital, you also have SoftBank, you have Title Global, and there's so much of capital being put to work. So, what does that mean for private equity firms to operate in an environment where capital is really super abundant? How are you all establishing your modes of differentiation?
So I think it's a great question. Globally, obviously, it's a situation where interest rates have been so low for such a long period of time, and with the liquidity being pumped in by reserve banks everywhere, it has created a situation of excess liquidity and therefore lots of excess capital floating around. Um, Now, having said that, I don't see that situation sort of continue forever. All right. So, before we get into those aspects, I think over the course of the next 18, 24 months, clearly the world, the world's at some point there will be some tapering. There will be a return to normalization of interest rates, and that may be a point where there may be a much welcome, much needed sort of correction. That may come in overall in capital markets as a whole, public markets, listed equities, private markets as a whole. And I think that will be useful, and it's actually a much needed in the marketplace, because it leads to sort of removal of the excessive euphoria that we are seeing today. Having said that, what may
That's well
happen
said.
actually, what I do see also is that, look, currently, while you're in that frame, where there is too much liquidity available, the point is the differentiation is driven by the sector approach, right? So if I look at risk capital funds, we'll never have like 100% of our money in new economy or digital ever, right? We are today, even as we speak, we probably have about 20%, of our funds into sort of new tech area. And there is risk element to it. If, one sector is heated up, it doesn't mean that, there is, something happens to it, doesn't sort of destroy your fortune as a fund. So there are risk management techniques in play, and you manage it accordingly. Of course, if there's a trend, it actually helps in the overall returns, if that even the 20% ends up doing well. So we do it from a risk management lens point of view. You create differentiation by really focusing on your vertical. So if you are, let's say, in business services, for example, right? If you've been investing in it for the last 20 years, you had a track record of actually seeing very strong exits. Take recently, we exited Infogame, right? Very, very strong exit that we had in that situation. But even Liquid Hub, which is Capgemini, right? So there is a track record of actually having done well. It attracts other entrepreneurs to say, okay, ChrysCapital is part of the journey from point A to point B. Can we do it again, right? And there's obviously learnings we've had doing that several times over, right? Which we then bring to the table, and not just learnings, but I would say network. What people we bring onto the board. People we bring in from the management experience from being in the previous companies, and the network that kind of gets built on. So the value add portion of it is very, very important. I'll give you a couple of examples right now. You may not necessarily be aware of it, but for example, in ChrysCapital, we also have our internal consulting group, which we've been building over the course of the last 5 years. It's a group called Enhancing, where their only role is to do actually project management and consulting projects within the company. And the background of these individuals are from the McKinsey, Baines, Alvarez and Marshall, EY consulting background, but also operational consulting. So we would actually pick up projects, actually deliver them inside our companies, and then obviously other things that you could bring into the table are M&A, which is a very, very strong piece of benefit that we can bring to the company. Not just the ability to do M&A sourcing, but actually integrating those companies into the so giving leverage to the CEOs to say, look, we will do it soup to nuts for you. So it's not just not just color of our capital is green, but there is some real benefit that we're bringing to the table. And we've now, as a portfolio, as a fund, we've done over 50 M&A transactions. And lots of learning in that, in terms of structuring, in terms of bringing retention of the key people involved. How do you sort of source it? How do you integrate it? What are the lessons learned, which we bring to the table? Which, as an individual company, you've not probably not done that kind of flow, certainly. So I think these are the couple of areas, and of course there are lots of allied ancillary areas we work on inside the company. But the intention obviously is to roll up our sleeves and work hard alongside, and ultimately, we want to be the go-to guy. We want to be the guy who actually wake up at midnight and, as an entrepreneur, want to figure out, okay, something just went wrong. Who do I call? We want to be the call that the person does. So from a relationship point of view, that's really what we intend to aspire for.
That's well said. So besides financial engineering, a lot of operational excellence also comes to board. And like you mentioned, you have been putting together this internal group. You also mentioned that there is excesses in the environment. I think it would be rational that there's some tapering that happens, and perhaps the party needs to stop at some time. So do you think that we are in a bubble? I mean, why are investors not using the B word yet?
So I don't know. It's hard to say. When is top, when is all of these things. Timing becomes. Ultimately, if you're in a good economy, in a good sector, in a good company, you look at the micros good. It generally plays out over the long run, right? So high quality companies find ways to kind of make that. But I think as a fund, I will strongly say that look, there has to be caution in the air right now, right? It's very clearly, when you ask yourself again, the barometer of where are you between greed and fear, is very clearly greed. And is very clearly, returns, being made very, very quickly. And whenever that happens, history has taught us that, look, it's much easier to make mistakes because a rising tide lifts all boats. And the aspects of diligence, aspects of really understanding your companies that you invest in can be given the short drift at that point in time. And I think our awareness should be higher at this point of time to really recognize that those mistakes can be made. Not to say that everything is going to turn to dust at this point. It's not that. I mean, the long-term trends are all very positive, but you have the large headwind of interest rates rising at some point in time, and your companies need to be strong enough to be able to withstand that, strong enough to withstand a capital shock to the system that could come at some point in the next 2 or 3 years, right? And when that happens, we should be able to navigate that. So your companies need to be strong enough to do that. And if you're backing the highest quality companies, yes, I mean, if you paid up, you could end up losing some money initially, but over time, if you can really say that you're backing a company that has a trend for the next 8 to 10 years behind it, I think you'll be okay. But you need to back the best quality companies at this point.
That's well said and well put, Sanjay, that there has to be caution in the air for private equity companies also, and to be very mindful of what they're doing. And as you mentioned, that you don't want to be a situation that when the party is over, you're collecting the broken plates. And that brings me to my next question to you, Lalit. Deals are really happening very fast, as you can see, and Sanjay repeatedly pointed that out. From a diligencing perspective, what really are the considerations one has to keep in mind now? And how has diligence changed, especially in an environment where you're doing almost everything in a synthetic fashion? You don't have the luxury of meeting people physically. You have to put so much capital to work. There's technology deals, FOMO is playing out. So how has diligencing changed in the new normal?
See, even earlier, I think when we were doing physical diligence, which means as lawyers and as advisors, we used to actually go to the site and demand documents and sit there. And there was time when we were not even allowed to take the documents in writing with pen, and we used to do with pencil. But times have actually changed. Even well before the pandemic hit, people have moved, and it's the norm now to do a virtual diligence. As we say, the VDR is created, and that trend was already there for several years now. I think both the companies, investors, and even the lawyers and advisors are trying to move to digital and virtual data room. Of course, the pandemic forced us to do that, even if we wanted to go out and do the diligence ourselves, but we had to confine ourselves to the virtual data room. So my experience is that even in the virtual mode, I think the document flow and everything is very, very good. In fact, we are more cautious to see that we have got all documents. However, if we have to actually see something which can only be done when we go externally, for example, when we are doing a real estate check or diligence or title verification, you can just rely on the documents and see, but you have to physically go to the sub-registrar's office and get it verified. Other than that bit, I think everything has very smoothly moved to virtual. We are getting documents, the deals are getting discussed, the diligence findings are getting discussed with the investors virtually. So I would say nothing really has changed. In fact, that has even given speed to the pace with which deals are happening, because now we are using the resources available for many diligences at the same time, because we don't have to move resources so much. But especially when it comes to tech companies, let me just add here that the focus of diligence, whether we do it virtually or physically, is slightly more than we do in a traditional manufacturing or a real estate company or a traditional company, because we just do not rely and look to the documents relating to contracts, finances, litigations, licenses. Tech companies generally have a different thing, and we focus on important things like their customer contracts, right? So what kind of contracts have they written with their customers? When it comes to customer contracts, we look at their data privacy, because that's very, very important. How do they protect the data of the customers and the clients that they have? Because with the increasing trend of people being very, very cautious of how their data is being protected, and the companies protect this, and like in the West, there are lawsuits claiming huge compensation. It's still not maybe happening in India yet. So we focus very much when we do a diligence on any tech company on the data aspect of it. Then the IT policy. So because if you see, the legal diligence generally is for legal documentation and legal issues, but we tell our investors that they should get a specialist technical team or a technical professional who comes and does the diligence related to technical aspects. For example, the source codes and whether all the IT and related and tech related compliances have been done. So we do that. We also see the confidentiality information and confidentiality documents, the non-disclosure agreements of confidentiality, which is part and parcel of the data privacy also. So in addition to all that we used to do in the pre-pandemic times, the things do continue the same way as far as even virtual diligence is concerned. But when the focus is of a tech company, we just do not rely on the old age diligence. We really go into this and question them, the best practices for their IT, and then we report that, and the risks are, and we've seen investors asking us specific questions. For example, like one of the transactions that we did recently, I mean, there was just everything was okay, but the tech compliances were so sort of casual and non-compliant that the investor was really, really concerned, because they were putting the money in the tech company. So I think, yes, there's a lot of capital chasing these deals. One other aspect we are seeing of late is that because the pace with which the deals are happening, series are happening, A to B to C, D, E, F, and they happen at a very, very short interval of time. So generally, the target entities do say that, look, the diligence was conducted just a few months back. There is no need to conduct further diligence. You rely on the reports, diligence findings that was carried out a few months back in the last round. But we still strongly urge that there shouldn't be any substitute of a full-blown and a real good diligence where the red flags have been found and they have been adequately captured, whether in the forms of reps and warranties or special indemnities or compensation or indemnity provisions in the transaction document. So whatever form that we are in, even during this pandemic phase, we should not sort of compromise on diligence, especially when we do diligence of new age tech companies.
Okay, thanks for that, Lalit. I want to sort of come to you now, Trishit. We spoke about diligence in the technology companies, but take us through what happens in cross-border technology deals. What are the considerations coming to the fore there? And I also ask you this, just in the light of what's happening in China with the recent clampdown on technology companies, what lessons can really be learned from there?
Thanks. Thanks, Sri. So, yeah, so I think, as cross-border deals, and we can talk about ourselves. So most of the time we land up, advising the foreign investor or the foreign fund who's investing in an Indian company. So I think, Lalit mentioned quite a bit of it. And what we see is that, when the discussions are on, before the term sheet stage and so on and so forth. So there is a lot of, promise before the diligence actually happens and we get into the company, the target company, and look at the affairs of the company. But before that, a lot of discussions happens at the principal stage between the promoters and the investor. So and we are told some of the things that which is very hunky dory as far as the Indian target company is concerned. But there is a huge mismatch when we actually get into the diligence and look at the the various aspects. One of the aspects for a cross border deal, and when we are talking about tech companies, is as Lalit also mentioned, is the data protection and data privacy aspect. So as if these investors are from European countries, the GDPR issues and all of those things, so and even in other Western countries, so they are very, very careful about how data is collected, how it is processed, transferred, stored, etc. Though we are talking about a data privacy bill, which is still in the form of a bill right now, yet to become an act, and how these aspects of data protection and privacy aspects would be dealt with. But we have seen that Indian target companies really lag in that aspect. And what happens is that when we try to do the diligence, so most of the things we try to correct before closing, right? But that unfortunately doesn't happen because the investment cannot wait for various reasons. So the entire thing gets shifted to a condition subsequent or a post-closing activity. And once that happens, what we have seen is that it takes a lot of time, effort, and money. And literally, it kind of the onus shifts from the promoters to the investors to kind of have all these compliances in place in terms of data protection, etc. Because if you look at technology companies, whether it is in the healthcare sector, whether it is in the e-commerce sector, education sector, so they deal with a lot of data related aspects, right? And you cannot ignore that aspect. So this mismatch during the process is a huge thing that we have seen. The other mismatch, which and the concern which we have seen, is on the valuation of the Indian companies, right? So and of course, when we are talking about a cross-border aspect, so the automatically the foreign exchange regulations comes into play. And in recent times, though we have seen a locked box pricing mechanism, but many of the deals happen as a post closing price adjustments in the form of earnouts or escrow mechanisms, etc. And we know that under the foreign exchange regulations there are limitations as regards the time period when you do an escrow mechanism and pay it in a staggered basis, or even the quantum of the payment that is to be made. So in that aspect, what we have seen is that many investors, when they embark on a deal, they actually look at a complete buyout, but eventually because of these issues they end up doing a staggered acquisition which spreads over a period of 1 year, 1.5 years, 2 years, looking at the performance of the company, etc. The other issue for tech companies is the entire aspect of protection of intellectual property. So in whichever field the tech companies are, it's very clear that intellectual property becomes the backbone of the company, right? So again, as far as Indian promoters are concerned, and when we look at foreign investors, they again treat intellectual property to be of great importance. But here, as far as India is concerned, there's a lack of knowledge, understanding as to how to protect your IP, what to do with your IP, and how to deal with it. Even for infringements as regards IP related issues, I think our enforcement agencies as well as the courts have very limited knowledge in terms of how to enforce these, and these enforcements needs to be done at a very quick and a quick without any time lag, if I may say so. But the courts and they fail to understand the nuances of how to protect the IP, and thereby it creates a lot of disruption and damage for the companies that hold these IPs. Then again, I think one aspect which is clearly playing out, and which we all know, is the Press Note 3 of 2020. So it is creating a lot of issues even after 1.5 years that has been kind of come into play. And during negotiations of cross-border deals, and when investments are either coming directly or indirectly through, for example, China, so there are a lot of negotiations happening between the investors and the target company, the promoters, as to how to deal with this, how to kind of get declarations from investors whether Press Note 3 would trigger, would not trigger, and hence the negotiation period and time for closing of transactions, it is getting extended. Now, coming to your second point of the China aspect, yes, we have seen a lot of crackdown, and we are looking at news on a daily basis for crackdown by the Chinese government on Chinese tech companies. But look, I think my view is that China has been known to be autocratic and dictatorial, right? So India is not is in the same position, right? So the issue is that it would not, I believe that to that extent it would not happen in India, that the way it is happening in China. And of course there are ways and means to even challenge the government in India, and suppose if it happens, right? I mean, let's take it in that way. So I think what Indian companies, they need to do is that they need to be aware of their rights under laws, what they can do, and even they can move the courts against the governments, right? I mean, it's not a situation as we are seeing in China that's panning out. So and I think even technology companies, they have their associations, and they can provide their comments, inputs to the government before any rules and regulations come into play. And even if those rules and regulations, as I said, come into play, which adversely impact their operations and businesses and revenues, they can definitely challenge those. So I think that is one learning. The other issues which we are seeing in China, because of which the Chinese crackdown is happening, is because of the fact that various, for example, the antitrust authorities, they are going down heavily on these tech companies, right? So I think get your house in order. I think that is very important. And if you know, and if you comply with all the requirements of law, hopefully things would not be out of place. And pay the right wages to your laborers, right? I mean, that's one aspect. That's what China is also looking. You may want to engage in the social structure by spending more, getting into activities of CSR, where you join hands with the government on social security kind of issues and aspects. So these are the things which you can learn if at all such a thing happens. But my belief is that we will not see this kind of a situation. Still, I think the law of the land prevails, and there are safeguards available to Indian citizens and Indian tech companies. as a whole.
Okay, thanks for that, Trishit. I think we spent quite a lot of time on the diligence aspect for technology companies, the cross-border deals, the China aspect. I think this was the last round of questioning. There seems to be a constant slugfest, between the investors slash entrepreneur fraternity and the regulators, especially when talking about technology. Just given technology is innovating so fast, technology companies like Sanjay also mentioned that the agility is just too much to keep up with even for the investor's perspective. And regulation is not being able to keep up with technology, which is why we have this entire new stream of narrative or conversation around RegTech. I'll begin with you, Sanjay. If you were to give me one example, one experience that you had where a potential technology investment requires so much regulatory clarity, which was to the point of exasperation, frustrating, and perhaps had a huge lesson that you had to learn from this entire incident. Get on to Lalit, you, and then Trishit. The entire one last piece around the entire RegTech narrative and how that is evolving in India.
Yeah, I think look, technology is regulation. It's not necessary. Regulation in general in India is tricky, right? I think in across sectors we've had to deal with it. Whether it was investing in sort of telecom, the time of idea, or when you had new licenses coming into play, or we were in the even in sort of media licenses at play. The different aspects have really played out in technology. Our general response has to be to actually stay away from regulated industries as much as we can, because to that extent there's always movements back and forth, and they tend to disrupt your investments, and we don't like that kind of risk in general. But you can't fully, you're ultimately, in any sector you have, even financial services for that matter, right, which we are big investors in, does have regulatory risk. But you have to understand what the regulator is trying to do, right, and follow the spirit of it. And if you're in that side, I think in general, rest of the thing kind of flows through. If you're in spirit, if you're just playing the margin in those companies where you may be okay about the letter of the law, or even the letter of the law might change and you feel it's okay, those types of risks we generally try and avoid, because that's where I think you end up taking undue risk, and that's in general a philosophy we kind of taken. Now, having specific examples, I think I will spare you some of those details. But what I will say is that in almost anything that we do, especially in the new tech sector, that those angles become very clear, very, very important to kind of navigate. I mean, we are investors in Dream Sports, for example, right? And there is an element of regulatory risk that's involved in that company, right? And we've gotten comfortable with the way the various situations are lining up, where the way judiciary has actually responded to that. So, but the question is, are we following the spirit of the law? Are we following the letter? In that case, we feel very clearly that the spirit of the law has been fully followed, and so that's how we get comfort in those situations.
Thanks for that, Sanjay. Lalit?
Shirja, I'll take cue from what Sanjay mentioned. I think the rules have to be followed in substance rather than in form. The example of on all that online e-commerce policy, there is a complete misunderstanding, if I may use that word, between what the regulators want it to be read as and what the companies, online platforms and tech companies read it to be. So definitely, I would say a clear clarity and government's position on what it intends to do. I mean, every time a new policy comes, there is a draft, and draft comes again, and there's one which is already up there, and soon it will become a policy. Then who knows that after that again, the things will be read completely in letter, because that's been the case as far as definitely the e-commerce policy and online platform policy is concerned. So therefore, no matter how much the government keeps trying to keep pace with the innovative and creative ways these tech companies try and not follow the rules in the true sense. So therefore, they will always be at variance what one wants to do in those policy and one what is actually doing there. So I would say that yet we should not underestimate the requirement of having a very clear-cut law, because this is very important, because it drives away the capital. You change the policy later on and say this was the intent of the policy, and therefore just drive and just trouble and irritate and annoy the foreign investors. So that will dampen the things. You mentioned earlier, Shirja, about Zomato's IPO. I think one very interesting issue that had come up during the Zomato's IPO is all these investors who invest in the companies when they are startup and they are going to go for IPO after 4-5 years, then all of them invest as FDI investor, because in an unlisted company you are always as an FDI investor. But when the company goes public, these investors who hold their FPI license from SEBI are also allowed to invest as an anchor investment during the IPO. Now there is some disconnect, which happened, and the Reserve Bank of India, unofficially at least in that IPO, explained and clarified that the same investor cannot be an FDI investor and as an FPI investor. I think the policy was very conservatively read, very narrowly read. Perhaps the entire aspect of how things work was not clearly explained, perhaps, to the Reserve Bank. I think that needs a relook, because what is happening, there is quite a bit of ambiguity now, that when a investor who was invested in a company when it was not listed had no option but to invest as an FDI investor. Later on, when the company goes for a IPO, wants to invest as an FPI investor, and then the rule, which is in the NDI rules, says that the same investor cannot invest as an FDI and as an FPI investor, I think needs to be read in the correct perspective, and therefore there has to be a clarity as far as that is concerned. So my 2 bits will be this, that certainty around the online platform is the need, and also more recent, this issue which has come of investing as an FDI come FPI investor. There should be clarity. Whatever the stand of the regulator is should be made clearly known. Otherwise, we are just juggling with too many regulations and too many doubts around that.
Okay. Trishit, what about you?
Yeah, so Srija, I would not want to get into the details, but I think, as Sanjay also mentioned, so not only the tech sector, but I think, across various sectors, whenever we have had, new rules, regulations, policies in place, of course, there has been a lot of ambiguity, moving around in the minds of investors, moving around in the minds of the Indian companies as to what they can do, what they cannot do. I think the learning that we should do is that constantly engage with the government if required, and there are ways and means where you can provide your inputs and provide your feedback on a draft bill or a draft policy. So do that, and obviously if there is any ambiguity, even when a policy is in force or it becomes a law, I think it is better to take a concerted, safe, conservative view than to, try to kind of do things creatively and then get into a lot of mess, and then the regulators, coming after you. And of course, I think, awareness and across various sectors, and specifically in the sector that a company is engaged in, I think that is what is required. But yes, you can't help it, the way tech is moving, you cannot even blame the government, because they have limited resources to come up with laws every day and every hour. Sometimes it happens in that way. So we have to live with it, but be aware of what is happening and take considered views and move forward.
Okay. Thanks for that. I think we had a pretty meaningful discussion today, starting from technology investing, what really is at the heart of deal making, what are private equity investors looking for, diligencing. Sanjay spoke quite a bit about the caution in the air, how it is needed, past experiences, where we are headed, cross-border deal activity, and the entire slugfest between the regulator fraternity and the investor fraternity. Now it's time for some quick rapid fire on a lighter note, and I'll begin with you, Sanjay. If you were to give me one deal which you wish you would have done in the past 12 months, what would that be? Your anti-portfolio.
Interesting. I would have loved to actually do the JV Chemical buyout deal that was pulled out. It was very large for us, but I think it was one that would have been a very interesting one to pull off.
Okay. And if you were to tell me one book which you read in the past 12 months, which has taught you quite a few things that perhaps made you a better person, what would that be?
I think the one thing that's really taught me stuff is actually reading through my children's stories, and it's very interesting because some of those things we forget. And we look at all these exotic books, but some of the basic things that are covered here actually bring your value bearers, your value system right. I think those are very, very important in investing in life in general.
Okay, the biggest fad, which is the sector which you think is the biggest fad right now and very frothy?
New tech, all that we've spoken about, very frothy.
So within that, what do you think is the fad? Is like, for instance, electric vehicles, consumer internet. What do you think is the biggest fad right now?
I'm just going to keep it at new tech at the highest level.
Okay, and which deal do you think which sort of you were very overawed with? Your own ChrysCapital deal in the past 12 months, which was an extremely satisfying experience.
Sorry, the one which we ended up doing?
Yes.
Lots of very interesting deals that we did, but I think I guess Corona Remedies would be right up there in terms of what we managed to do.
Okay, Lalit, I have the same question for you. One deal which some other law firm advised on, which wish you could have done.
Well, I would say, of course, my firm did advise on Zomato, but we were for the selling shareholder. I would have loved to be there. And similarly, there's an ongoing one, which is, of course, my firm is advising on that transaction. I would have, but I'm personally not involved, is the Paytm transaction. So I would, the IPO. So I would have loved to be there to see everything about how the deal happened, what were the agreements, how things which start like as a startup company turn into unicorn and go for IPO, and look at the valuation and the news and everything that they're creating, ripples they are creating. So I would have been very happy to be part of that real excitement, although of course my firm is working, but personally I would have enjoyed that.
Okay, what about you, Trishit?
So I think, Srija, I don't have a fear of missing out. So, but even otherwise, if you ask me, yeah, I think the Geo Platforms deal would be one where I think वही बोलते हैं ना बहती गंगा में हाथ. So even if you don't do anything, but still your name comes in it, and kind of it takes you to at some level. So I think that is one deal which maybe, but otherwise I'm okay doing the variety mix of Japan India deals, US India, even some of the domestic deals, though those are kind of few. Yeah.
Okay, I think my last question, and I have to ask you this, Sanjay. What is your view on some of the upcoming IPOs? I mean, there's a Paytm IPO, Delivery IPO. I mean, what will really break the camel's back? What do you think?
Look, I think the froth in the IPO market, I don't see it sustaining beyond a point, right? So I think that only takes, 2 or 3 bad IPOs for that, to kind of break in a way. Lots of people are looking to access the capital markets, and we've been there before. I mean, there have been periods of exuberance in IPO markets in the past as well. I don't think everything is going to, just fly like that. I mean, because people start building expectations that it's going to be a double and it's going to, be 50% up or 70% up, right, on this thing. It may play out for a while, but these things generally don't last. So I would be, remember, ultimately incentives. There are selling shareholders on the other side. You as retail investors are, gullible and looking for making a small, quick, return. Probability weighted where the things are going to end up, right? It doesn't take rocket science to actually know that over a long period of time. You may make it work initially. I would just say, let's be cautious, especially to retail investors at this point. Don't have FOMO play out on these things, right? There will be, don't get me wrong, there are lots of great companies out there in India which will go public and will make you great returns over a longish period of time. But be prepared to stay the course, and be invested over the course of 5 to 10 years, and don't try to do a 1 month, 3 months kind of moving out. That journey may not end well.
Thanks for that. I think we had a wonderful discussion today, and a lot of good advice and word of caution coming to the fore, and very candid revelations. Thank you so much for this, Trishit, Lalit, and Sanjay. Till the time I see you next, goodbye and good luck. Thank you so much.
Thank you.
Thank you, Srija. Thank you, everyone. Bye.
Bye-bye.